So you want to buy a large cap tech US growth stock ETF. Well, I've got two contenders here that we're going to consider, and I'm going to give you my summary judgment. Should you buy VGT, the Vanguard Information Technology Index Fund, or should you buy QQQ, the Invesco NASDAQ 100 Index ETF? Now, if we just look at past performance, we can see that QQQ has actually outperformed VGT pretty massively, right? We have a 743% return on the far right here, compared to 672% for VGT. Now, the first lesson I want to teach you, if you just discovered my channel, is that past performance is 100% irrelevant. Now, you may say I'm crazy. You may say, but the past gives us clues about, what could potentially happen in the future. To an extent, you're correct. But also, the past is the past. It's done. When it comes to investing, investing is all about the future. And things that could have done well in the past may not necessarily do well in the future. And one of the funny things about investing is that things that have done well recently, there's more of a likelihood than not that whatever has done well recently, maybe even in the last decade, is probably going to what we call revert to the mean, which is return to the market's average return. And you see this all the time. You see certain asset classes, you see certain fund managers, you see specific investment pools, you see all sorts of stuff that does well for a short period of time, but then at a certain point, that massive outperformance actually declines, and things that have outperformed in the past have actually underperformed going into the future. Now, that's my suspicion for both the Vanguard Information Technology Index Fund and for QQQ. And I'm going to tell you why both of these ETFs are actually exceptionally dangerous for your portfolio. Starting with QQQ, the first thing I like to look at is concentration risk. How hyper concentrated is QQQ? Now, this ETF has 100 stocks, so you would think it's diversified, right? Well, riddle me this. What if I produce an ETF where I put 99% of all the ETF's assets in one stock, and then on that last remaining 1%, I put 1,000 other stocks and I split it amongst there? Would you say that's a diversified ETF if 99% of that ETF is in one stock and then the other 1,000 companies are split along amongst that last 1%? I would say that's a very hyper-concentrated ETF, and that's where you have to be careful and not be fooled. Now, QQQ isn't trying to deceive you. Obviously, they have this stuff flat out on their website, but you need to at least go look and see this stuff, okay, instead of just buying it because it went up a lot. If you look at the top 10 holdings of QQQ, you can see the number one holding is Microsoft Corporation with a total of 12.5%. That's pretty significantly weighted. The next one, Apple, 12%. The next one, Amazon, 6%. The next one, Nvidia, 5%. Now, why is this dangerous? Because you look at these companies and you say, hey, they've done so well, they're the future, they're technology companies, they're highly profitable. Why would you attack these companies when they're so highly concentrated? Because they're great companies, right, Christopher? Well, let me show you a company called Meta and what happened to Meta stock, Facebook, and what could potentially happen to any one of these companies in this index. Now, I present to you Meta Platforms. This is formerly Facebook. It's got Instagram, Facebook, WhatsApp, all sorts of things this company owns. This is a fantastic, highly profitable company that has recently gone through some troubles because of the the whole VR revolution that they're trying to push on people. But I can clearly see, and you can clearly see too, that this amazing company, which was trading at over $1 trillion market capitalization on September 10th, 2021, not too long ago, absolutely collapsed in price. It went from a high of $378 all the way down to $90.79. That is absolute, complete, and utter destruction. Now, does that mean this is a bad company? No. Does that mean you should potentially not invest in this company? No. It's really up to you. But what I can tell you is that if you look at QQQ, that could happen to Microsoft. That could happen to Apple. that could happen to Amazon. And the more concentrated you are in one stock, the more of that risk that you are taking on. Now let's go look at the Vanguard Information Technology Company, the technology ETF. And we can see that, wow, they have 367 stocks. That's way more diversified than QQQ, which only has 100 stocks, right? Well, you'd actually be wrong. VGT is one of the most dangerous, risky ETFs. And trust me, there's worse ones out there. But this is one of the most risky ETFs. Why? Because number one, it's had such great past performance that it entices investors to buy it. It's done so well. It's got all the big names. And number two, it's even more hyper concentrated than QQQ by leaps and bounds. And if you invested in this and you lost money, or one of these companies got wrecked, your ETF isn't going to be doing that hot. Now look how hyper concentrated this is. Apple is 22% of this company, 22% of this ETF. 22%, almost 1/4 of this ETF is in one company. You mean to tell me it's impossible that this could happen to Apple? You think that's impossible? Well, people probably thought the same thing about Meta, this hyper profitable, massive company that touches the lives of billions of people. It happened to Meta, and guess what? It could happen to Apple. It may not, but it could. Do you understand the risk? Okay? Look at Microsoft Corporation, 12% of the portfolio. So 40% roughly of this portfolio is in 2 stocks. 2. You don't see the risk here? You don't see the potential for catastrophe? But if you go up and you say, oh, well, hey, 367 stocks, it's actually more concentrated and more risky than QQQ. Now, if I had to put my money somewhere, and I'm not endorsing either one of these, I don't invest in either one of these, but I would actually more likely put my money in QQQ because it's actually more diversified. It has fewer companies, but the concentrations are so different, that at least QQQ is spread out amongst other ETFs or other stocks, which is far less risky. Now, me personally, I'd rather own a total market index. I'd rather own every stock in the world. That's what I do. But if you are thinking about buying any one of these investments, you have to understand that past performance is not indicative of future performance. That is a huge mental block that people have. They don't seem to grasp that concept, number one. And number two, these are both very highly concentrated ETFs, and there are some associated risks with that. So I hope you learned something. I hope you learned that at least you should research what you're buying instead of just looking for stuff that went up a lot and buying that because it went up a lot. Be careful out there. Really understand what you're doing. Consider a total market or even a total global market index, and have a wonderful day.